Mortgage rates in America are still one of the biggest forces shaping the housing market in 2026. And right now, one number is influencing almost everything. Who can buy, who can refinance, who refuses to sell, and why the housing market still feels stuck. As of late May 2026, the average 30-year fixed mortgage rate is still around the mid-6% range. Freddie Mac reported that the 30-year fixed-rate mortgage averaged 6.51% as of May 21, 2026, up from 6.36% the week before. The 15-year fixed-rate mortgage averaged 5.85%. Some daily rate trackers showed even higher numbers. Bank rate data reported by WSJ showed the national average 30-year fixed mortgage rate at 6.70% on May 26, 2026, with the 15-year fixed rate around 6.05%. So the first thing homebuyers need to understand is simple. Mortgage rates are lower than the peak levels of 2023, but they are still much higher than what Americans became used to during 2020 and 2021. And that difference matters a lot. Because a home buyer is not just buying the house price, they are buying the monthly payment. A few years ago, many buyers could borrow money at around 3%. Today, many buyers are facing rates around 6% to 7%. That completely changes affordability. A house that may have felt affordable at a 3% mortgage rate can feel very different at a 6.5% mortgage rate. And this is one of the main reasons the 2026 housing market feels so complicated. Home prices have slowed down. Inventory has improved in some areas, but the monthly payment is still difficult for many buyers. According to FHFA data reported by Reuters, U.S. single-family home prices rose only 0.1% in March 2026 and were up 1.7% from a year earlier. That means national home prices are still rising, but the growth is much slower than during the pandemic boom. Case-Shiller data also showed slower growth. The National Home Price Index increased only 0.7% year over year in March, slightly below February's 0.8% increase. So this is the key point. The housing market is not rising like crazy anymore, but prices have not fallen enough to fully fix affordability. That is why many buyers still feel pressure. Not because every home is getting more expensive every month, but because mortgage rates are keeping the monthly payment high. And in real life, the monthly payment is what decides whether a buyer can actually move forward. This is also why refinance activity is important to watch in 2026. Refinancing means replacing an old mortgage with a new mortgage. Homeowners usually do this for a few reasons. They may want a lower interest rate. They may want a lower monthly payment. They may want to change from an adjustable rate mortgage to a fixed rate mortgage, or they may want to pull cash out of their home equity. But refinancing only makes sense when the numbers work. And right now, the refinance market is very sensitive to small changes in mortgage rates. Or they may want to pull cash out of their home equity. But refinancing only makes sense when the numbers work. And right now, the refinance market is very sensitive to small changes in mortgage rates. Fannie Mae's Refinance Application Level Index showed that for the week ending May 15, 2026, refinance dollar volume decreased 3.7% from the previous week. But compared to the same week last year, refinance dollar volume was still up 43.8%, and refinance count was up 39.4%. That tells us something important. Refinance demand is not dead. But it is not exploding either. Homeowners are watching mortgage rates very closely. When rates move lower, refinance interest can improve. When rates move higher again, refinance activity can slow quickly. And that makes sense, because many homeowners already have much lower rates from previous years. If someone locked in a mortgage at 3% in 2021, refinancing into a 6.5% mortgage in 2026 usually does not make sense. They would be moving from cheap debt into expensive debt. That is why many existing homeowners are staying exactly where they are. This is called the lock-in effect. People may want to move. They may want a bigger home. They may want to downsize. They may want to move to another state. But if they sell their current home, they may lose their low mortgage rate and have to buy again at today's higher rates. So instead of selling, many homeowners stay put. And when homeowners stay put, fewer homes come onto the market. That keeps supply tighter than it would normally be. So the mortgage market is affecting both sides. It affects buyers because high rates make monthly payments more expensive. And it affects sellers because low-rate homeowners do not want to give up their old mortgages. This is one reason the market can feel frozen. Not completely crashed, not fully recovered, just stuck. What is the price of the house? The more important question is, what is the true monthly cost? Because the mortgage is only one part of the housing cost. A buyer also has to think about property taxes, homeowners insurance, HOA fees, utilities, maintenance, repairs, closing costs, and emergency expenses. This matters because even if the mortgage payment looks manageable, the full cost of ownership can be much higher. For example, a buyer may look at a mortgage calculator and see a payment that seems possible. But once property taxes, insurance, and maintenance are included, the real monthly cost can be hundreds or even over $1,000 higher. This is especially important in states where insurance and property taxes have become a bigger issue. Florida is a good example. Texas is another. Arizona is also worth watching. These states saw strong demand during the pandemic housing boom, but now buyers are much more careful because monthly ownership costs are higher. From my point of view, this is one of the biggest changes in the housing market. In the past, many people focused mostly on the purchase price. Today, smart buyers are focused on the monthly survival number, not just the mortgage, the full payment. Because a home does not just cost money when you buy it, it costs money every single month after you own it. Now let's talk about whether refinancing makes sense in this market. In general, refinancing may make sense if a homeowner can lower their interest rate enough to offset the closing costs. Many refinance deals come with closing costs. These costs can include lender fees, appraisal fees, credit report fees, title fees, taxes, and other charges. A common estimate is around 2% to 5% of the loan amount. So if someone refinances a $300,000 mortgage, the cost could be around $6,000 to $15,000. That does not mean refinancing is bad. It means homeowners need to calculate the break-even point. The break-even point is simple. How much does the refinance save each month? And how long does it take for those monthly savings to cover the cost of refinancing? For example, if refinancing costs $8,000 and saves $250 per month, it would take about 32 months to break even. If the homeowner plans to stay in the house longer than that, refinancing may make sense. If they plan to sell soon, it may not be worth it. This is why people should not refinance just because the monthly payment looks lower. Sometimes the payment goes down because the loan term gets extended. For example, a homeowner may already be 10 years into a 30-year mortgage. If they refinance into a new 30-year mortgage, the monthly payment may fall. But now they may be restarting the clock. That can reduce short-term pressure, but it can also increase the total interest paid over time. So the real question is not only, will my monthly payment go down? The better question is, will this improve my total financial situation? That is a very different question. There are still situations where refinancing can be useful. If a homeowner has a high rate and can refinance into a meaningfully lower rate, that can help. If their credit score has improved since they first bought the home, they may qualify for better terms. If they have an adjustable rate mortgage and want more stability, refinancing into a fixed-rate loan can make sense. And if they need cash for a serious purpose, like home repairs or debt consolidation, a cash-out refinance may be an option. But cash-out refinancing should be handled carefully, because it turns home equity into new debt. And if home prices weaken in the local market, that can create risk. This is why 2026 is not a simple market. It is not a market where every buyer should rush in, and it is not a market where every homeowner should refinance. It depends on the numbers. It depends on the location. It depends on the household income. It depends on the rate they already have. And it depends on how long they plan to stay in the home. Mortgage applications are also showing that buyers and homeowners are reacting carefully. U.S. mortgage applications decreased 2.3% in the week ending May 15, 2026, according to MBA-related market data. That kind of movement shows how sensitive the market is. When rates rise, some buyers step back. When rates fall, some buyers return. This is the pattern to watch for the rest of 2026. Personally, I think the most important thing in the mortgage market right now is not whether rates move a little higher or a little lower in 1 week. The bigger issue is whether mortgage rates stay high long enough to permanently change buyer behavior. Because if buyers start thinking that 6% to 7% mortgage rates are the new normal, then the entire housing conversation changes. People will budget differently. They will buy smaller homes. They will move to cheaper markets. They will compare renting versus buying more carefully. And they will pay much closer attention to taxes, insurance, and maintenance. That may actually create a more cautious and more realistic housing market. Not necessarily a bad thing, just a very different market from the low-rate years. In 2020 and 2021, cheap money made many buyers move fast. In 2026, expensive money is making buyers slow down and calculate. And that is probably the biggest story. The mortgage market is forcing Americans to become more careful, more numbers-driven, and more focused on monthly reality. So if you are watching the housing market this year, here are the key things to pay attention to. First, watch the 30-year mortgage rate. If it moves closer to 6% or below, buyer demand and refinance interest may improve. If it stays near 6.5% to 7%, affordability will remain difficult. Second, watch refinance activity. If refinance demand rises, it may show that homeowners are trying to take advantage of lower rates. If it drops, that means rates are still not attractive enough. Third, watch inventory. More homes on the market could give buyers more choices. But if many owners stay locked into low mortgage rates, inventory may remain limited in some areas. Fourth, watch home prices by region. National numbers are useful, but real estate is local. Some markets may cool, some may stay stable, and some may still be expensive because supply is limited. And finally, watch the full monthly cost of ownership. Mortgage rates get the headlines, but taxes, insurance, utilities, repairs, and HOA fees can decide whether a home is actually affordable. That is the real takeaway for 2026. The U.S. mortgage market is not just about interest rates anymore. It is about the full cost of owning a home in a higher rate world. For buyers, that means being patient and realistic. For homeowners, that means refinancing only when the math truly works. And for anyone watching the housing market, it means understanding that mortgage rates are still controlling the entire conversation. If this video helped you understand what is happening in the U.S. mortgage market right now, make sure to hit the like button and subscribe to the channel. On this channel, we cover the latest updates on the U.S. housing market, mortgage rates, refinancing, property taxes, insurance costs, and the real financial side of homeownership in America. And as always, let me know your thoughts in the comments below. Do you think mortgage rates will finally move lower later in 2026? Or do you think Americans are starting to adjust to a higher rate housing market?